This week we will cover the fundamentals of stock price valuation. In principle, the general approach here is similar to bonds and loans, and we will therefore not spend as much time with stocks. However, we will discuss the main differences in approaches and discuss the question how efficient asset markets like the stock markets really are. This will set up our discussion for the remainder of the course, which will focus on financial intermediation and banking. Now, common stock is issued only by corporations in an effort to raise equity capital. If you're not familiar with the term equity or capital in the context of accounting, no worries. We will return to these concepts later on. For now, just know that purchasing corporate stock is akin to buying a small ownership share of a corporation. Such ownership has certain benefits. Chiefly, a shareholder is the residual claimant on the firm's cash flows. That means whatever is left once the firm has paid off all debts to workers, contractors, suppliers, lenders, the government, and so forth, goes to the shareholders. Such shares require a firm to be profitable, to be valuable, and they're not contractually fixed. Payments are not contractually fixed, as is the case of debt. Rather, firms can choose to pay profit shares out in terms of so-called dividends, but at the same token, they might also just reinvest profits with the firm. The fact that share ownership requires firms to be profitable makes stock riskier than debt. As one offsetting factor, therefore, shareholders are given more rights than external lenders, such as, for instance, electing the board of directors, which is charged with supervising management. We will cover three concepts this week. The first relates directly to the valuation of stock markets, that is the so-called Gordon growth model. The other two extend to asset markets more broadly. We will specifically delve into the question how economists model expectations, which is the theory of rational expectations. And finally, we will also cover how this theory applies to financial markets, which is the so-called efficient market hypothesis. Now, conceptually, there is no big difference between pricing a bond and a share. Both are future payment streams, and their equilibrium price should be the present discounted value of the underlying cash flows. There are, however, two additional complications with stocks. For one, unlike bonds or loans, dividend payments are not contractually fixed at all. That makes them more uncertain. Some firms never pay dividends, even though they're profitable, preferring to reinvest instead. Now, as it turns out, this point is not particularly essential, but we still need to address it. The second difference is that stocks do not mature, so we have to evaluate a potentially infinite payment stream. As it will turn out, under certain assumptions, this is also possible. Now let's table the complications of expectations and uncertainty and start with a simple evaluation example that sets up addressing the infinity issue first. We'll return to the uncertainty aspect a little later on. Now, the first model here is known as the one-period valuation model, and the assumption is quite simple, straightforward. Say you want to buy some share, say Microsoft or GE or Tesla, whatever you like, hold it for 1 year, receive a single dividend payment, and then you resell it. In this case, we don't have to worry about infinity quite yet. In equilibrium, the no arbitrage price of this share is equal to the present value of the expected future cash flows, much like was the case with bond, much like was the case with loans. Now, what does this mean in this particular example? Formally, the price of a share is equal to its present discounted value. Present discounted value are its future cash flows discounted back till today. Now, in this particular example, there are two cash flows. For one, you receive a dividend payment. This could be some small share of profit, say 50 cents. And then you receive whatever the stock was going to sell for tomorrow. Both of these you discount once because you're holding them for one period using a discount rate called KE. Now, KE is a little bit different from what we've seen before. It's not equal to a yield. Rather, it is what is typically referred to as the required rate of return on an equity investment. You can think of it as the opportunity cost of holding stock, or you can think of it as the rate of return that someone has to offer you at minimum to be willing to hold a particular share. Now, we can further decompose the required rate of return into two components. For one, it includes the opportunity cost of holding stock, which would be holding, for instance, a treasury bond, the so-called risk-free interest rate. But because stocks are risky in practice, KE will also require an equity risk premium, you will require additional compensation over holding a treasury bond simply because the shares of Microsoft or the shares of GE or the shares of Tesla are more risky in terms of profitability than the US Treasury. We will work through a mathematical example of this in the first practice problem. For now, I'm just going to talk about extensions of this model to more complicated environments. Just to be clear again, the price of a stock is equal to the dividend payments you collect before you sell it, plus the resale value, everything discounted back to today. Now, you can hold a stock for one period, or you can hold it for any number of periods, say for instance N. And N could be anything. It could be 3 years, it could be 10 years, it could be 20 years, right? Stocks do not mature at any point like debt do. Now, say you hold a stock for several periods, for N periods. In order to figure out what that stock should be priced at, you simply look at the future payments it offers, dividend payment 1 year from now, discount that back once. You then add the dividend payment 2 years from now, you discount that back, and so forth. You do this all the way until you're selling the bond. And in that final period, you also take the resale price and you discount that back n times. So it's just an n period extension of the 2-period case that we saw earlier. Now, of course, stock doesn't mature, so technically you can hold a share as long as you want. You could hold it more or less until infinity, and you would still receive dividend payments for it. Now, this of course isn't exactly how firms work, but typically it's a fair assumption to assume that firms are ongoing. Microsoft is not going to last until the end of time, obviously. But we don't know how long Microsoft's going to be around. They could be around for 20 years, they could be around for 30 years, they could be around for another 200 years. So a potentially fairly long time. And because we're discounting fewer payments, these payments further out are going to become less and less important. Now, most importantly, the larger n becomes, the smaller will be the contribution of its resale price to the current price. And so if you're holding a stock for 20 years, what you're going to get in 20 years is less important to you than what you can get on dividends in the near term. Now, say for instance, conceptually, you were to hold a stock infinitely, right, until that maturity date, which will never happen. In this case, the present value of the resale value is equal to 0. Now, of course, infinity isn't an actual thing, but if you're holding a bond for a stock for 10, 15 years, and you're discounting the resale value back to today, it will, for all practical purposes, be 0. In other words, the approximate value of a share is then equal to the sum of all of its future dividend payments discounted back till today. Even if you're holding a stock for only one period and you're selling it next period, the price that it will sell at that point is the present value at that point. And of course, that also is a function of future dividend payments. So another way to get to this result is by iterating forward the future price using the present values at that point. Now, this is a little bit of a math argument, so if math is not your favorite topic, you can ignore it. There is intuition to this as well. What this equation is saying is really that what determines the price of Microsoft stock or Tesla stock or whatever is the profit shares that these firms can generate in the future discounted back to today. In investor terms, this is sometimes referred to as the value of a stock increases in its expected future earnings potential. Now, practice, this takes care of our infinity issue, but we still have the problem that we don't know what future dividend payments are going to be equal to. This is something that entire industries are built around, so we cannot really pay it justice in full detail here. But we can work through one simple approximation of this, which is the Gordon growth model. The Gordon growth model allows us to think about stock prices at a very top macroeconomic level. Now, what the Gordon growth model does, it simply assumes that dividend payments grow at some rate g, and g could be positive, it could be 0, it could be negative. And it does so, they do so for all times. Right? So the dividend payment 1 year from now is the last known dividend, div t, times 1 plus g. The dividend payment 2 years from now, under this assumption, is the last known dividend times 1 plus g squared, and so forth, and you do this all the way to infinity. Once you have all of these dividend payments, you discount them back, and that will give you today's stock price. Now, it can be shown with a little bit of algebra that this simplifies to the following expression. The stock price today of some firm is equal to its last known dividend payment times 1 plus g divided by KE minus G. I realize I'm pulling this out of a hat. I will post the proof to this online. I'm not requiring it because it's a little bit tedious. What is more important for our purposes is that this gives us a very parsimonious tool to think about what determines stock prices in a macroeconomy. And the two important factors here are G and KE. Now, G indicates how much more profitable firms become over time. Right? For instance, if G is 2%, that means profits of firms broadly in the economy are growing by 2% a year. What happens if G increases? If G increases, the numerator of this expression increases, the denominator of this expression decreases, and consequently stock prices increase. Future earnings potential of firms increases, their stock price increases today. That's all that reflects. By the same token, stock prices also depend on KE, the required rate of return. Now, what does that imply? For instance, if generally the perception of stock risk increases, stock prices, should all things else the same, fall. People will switch into treasuries, right? If KE goes up, the denominator of this expression falls, and as a consequence of that, increases, and as a consequence of that, stock prices fall. Another implication of that is the relationship between interest rates and stock prices. KE includes the risk-free rate. Now, if a central bank, for instance, cuts rates, it lowers the opportunity cost on holding stocks. It becomes less interesting to hold bonds, for instance. And as a consequence, what people need to be incentive to hold stocks is less. By the same token, lower interest rates also typically in a macroeconomy increase G. And it becomes cheaper to borrow. That makes it more profitable to operate firms. Now, when the Federal Reserve last March, for instance, slashed interest rates in response to the COVID lockdown, that in part allowed stock prices to recover as strongly as they did, because it made it less interesting for investors to hold bonds or hand out loans, and it made it cheaper for firms to reinvest. And that is one of the consequences why the stock market, one of the reasons, not the only one, but it's one of the reasons why the stock market has performed so well throughout the COVID lockdown period.